So imagine burning $1.31 for every single dollar you make.
Oh, man.
Right. And not in like some weekend side hustle where you're just figuring things out, but as a publicly traded multi-billion-dollar company.
Yeah, that's brutal.
It is. Like, you sell a product, and the sheer act of making and delivering that product actively drains your bank account. And that's before you even pay for, your corporate headquarters or your marketing or your research team.
Yeah.
For Plug Power, that wasn't just some hypothetical nightmare scenario. That was literally their reality last year.
It really was. I mean, it's the kind of unit economics that, keeps executives awake at night. Because when your gross margin is deeply negative like that, traditional business logic completely inverts.
Right.
Like, growth actually becomes your enemy. The more units you sell, the faster you accelerate toward bankruptcy.
Which is just wild to think about, but that is exactly why we are pulling apart this fresh stack of equity research today. This report is dated August 27, 2026, and we're looking at a vertically integrated hydrogen fuel cell and electrolyzer company that is attempting what has to be like the ultimate corporate tightrope walk.
Oh, absolutely.
So our mission for this deep dive is to figure out if this company has actually fixed its underlying machinery or if it's just, a massive value trap. Because right now, the operational data in this report is screaming one thing, but the balance sheet is telling a terrifyingly different story.
Yeah. The market loves a binary setup, and this is pretty much the definition of one. We have a company caught in a literal race between proving they can operate profitably and simply running out of the cash required to keep the lights on.
Right.
And to understand just how acute this tension is, we kind of have to look at the primary catalyst that makes this stock worth our attention right now, which is the second quarter of 2026.
Yeah, the Q2 miracle, as some of these analysts are actually framing it, because historically, like we said, the market has just hammered Plug Power for selling below cost. But these recent results showed a shift that caught Wall Street entirely off guard.
It really did.
They reported top-line revenue of $178.3 million. So that's up 2.5% year over year and up 9% sequentially from the first quarter, which is, solid growth, but revenue growth wasn't actually the shocker here.
No, not at all.
Yeah.
Because revenue is just vanity if the unit economics are fundamentally broken.
Right, exactly.
The metric that actually forced analysts to scramble and rewrite their models was the gross margin.
Yeah.
Because in Q2, Plug Power's gross margin improved to approximately break even.
Wow.
And to really understand the gravity of that, we have to anchor it to their history.
Yeah.
A year earlier, so Q2 of 2025, that margin was negative 31%.
Negative 31.
Yeah. And even just one quarter prior to this recent report, so Q1 2026, they were bleeding at a negative 13%.
Right.
So hitting break even, I mean, it is a massive structural pivot for them.
Okay, let's unpack this, though, because is break-even gross margin really something to, like, throw a parade for?
Well,
I mean, I understand it's an improvement, obviously, but the bar just seems incredibly low. Like, you haven't actually made a profit yet. You just figured out how to stop setting your money on fire on the factory floor.
yeah.
So why is the market treating, not losing money on the actual product as some sort of miraculous achievement?
Well, it's because for an industrial hardware manufacturer, stopping that factory floor fire is the single hardest mechanism to fix.
Okay.
Think of it like a software company. A software company can improve margins by, I don't know, tweaking server usage or just raising subscription prices overnight.
Right, yeah, flip a switch.
Exactly. But an industrial company like Plug Power has to physically alter reality. To go from negative 31% to break even means they likely had to renegotiate massive supply chain contracts for raw materials.
Oh, sure.
They had to optimize manufacturing yields so they aren't, wasting expensive components. And perhaps they even had to push through pricing increases to customers who are notoriously sensitive to costs.
Yeah, that's a good point.
So it proves to investors that the underlying business model isn't fundamentally broken. Once you hit break even on the gross level, any future operational efficiencies or, future scale finally has a chance to actually flow downward into corporate profit.
Assuming they can actually keep scaling, right?
Yes, assuming that.
And management seems to be projecting massive confidence that they will. Like, in this report, they raised their full year 2026 revenue growth guidance to a range of 15 to 16%. And even bolder, they reiterated this massive target, achieving positive EBITDAs by the fourth quarter of 2026.
Yeah. Drawing a line in the sand for Q4 positive EBITDAs is a really high-stakes credibility play.
Definitely.
We should probably clarify what that metric actually represents, though, for the listener.
Yeah, go ahead.
So it's earnings before interest, taxes, depreciation, amortization, and stock-based compensation.
Right.
It's essentially a proxy for operating cash flow. It shows whether the core business operations generate cash before you account for things like debt servicing or accounting write-downs.
See, I always have a healthy skepticism of EBITDAs, especially that S at the end for stock-based compensation,
Oh, yeah.
because it's a convenient way for companies to say, look, we're profitable, while quietly diluting shareholders by paying their executives in stock instead of actual cash.
Which is a very common trick, yeah.
But, I mean, regardless of the accounting gymnastics there, if they hit that target in Q4, it really shifts the narrative. They go from this cash-burning startup phase to a mature operating leverage kind of story.
It would be a monumental shift in market perception.
Yeah.
But, that target requires literally everything to go right over the next 2 quarters.
Yeah.
The operational wins are on paper, but we have to look at how the market is actually pricing this reality right now.
Right, which brings us to the most jarring disconnect in this entire research packet. Because if the company just pulled off a 31-point swing in gross margins, beat estimates, and confidently raised their guidance, you would completely expect the stock to be surging.
You would.
Instead, as of late August 2026, it's trading around $2.17 a share.
Yeah.
Over the last 13 weeks, it's down nearly 40%. It's sitting 13% below its 200-day moving average. It's just completely buried under all its major technical trend lines.
Right. And the reason for that is the market isn't going to blindly celebrate a gross margin victory when the bottom line is still just an absolute bloodbath. Because gross margin only accounts for the cost of making the product, right? When you factor in all the other costs of running a corporation, so administrative overhead, research and development, interest on their debt, the trailing 12-month net margin is a staggering negative 227.13%.
Wow. So for every dollar they bring in, they are ultimately losing more than $2 overall.
Exactly.
That translates to a net income loss of negative $433.5 million just for the first half of 2026.
It's a massive hole.
Yeah, and Q2 alone, despite that gross margin improvement, still contributed negative $188.2 million to that hole.
And this is where the tension becomes a full-blown crisis.
Yeah.
An operational turnaround, it takes time. You need quarters, sometimes even years, to scale those new efficiencies.
Right.
But Plug Power doesn't have the luxury of time because their balance sheet is essentially a ticking clock. The most critical data point in this entire report isn't the margin at all.
Okay.
It's the liquidity runway.
Yeah, let's talk about that. Because on the surface, the report notes they have a broader cash position of over $2 billion. And if I'm, a retail investor just glancing at a screen, $2 billion sounds incredibly safe.
It sounds great.
But the report immediately waves a massive red flag. Most of that $2 billion is restricted cash.
Yes.
They're readily available cash-like. The actual money they can use to make payroll tomorrow or buy raw materials is only about $162 million.
Right. And restricted cash is a concept that often traps novice investors. That $2 billion exists? Absolutely. But it's legally walled off.
Oh, whoa.
Well, in heavy infrastructure and green energy, massive amounts of cash get tied up as collateral for long-term projects.
Oh, I see.
Yeah, or it's held in escrow for letters of credit, or locked down by debt covenants that they've negotiated with banks.
Yeah.
Management literally cannot touch it to fund daily operations.
Wow.
So in reality, they are operating a multi-billion-dollar enterprise out of a $162 million checking account.
And here is the terrifying math on that. Against that $162 million checking account, their quarterly net cash usage is roughly $61 million.
Yeah.
So this is basically like driving a car down the highway. The engine is finally running perfectly after months of misfiring. You're hitting your optimal speed. But the fuel gauge is physically resting on empty.
That is the perfect analogy.
You can literally see the gas station on the horizon, which is that Q4 positive EBITDA's target. But if you hit even one red light, you're completely stranded.
And honestly, it's actually worse than just being stranded.
Yeah.
Because in the financial markets, when a company runs out of cash, the tow truck that comes to rescue you demands a massive piece of the vehicle in return. That tow truck is an equity raise. The market is absolutely terrified that Plug Power will be forced to issue millions of new shares just to bridge the gap between their current 162 million and that Q4 profitability target.
Which introduces the concept of the equity risk premium. If you hold shares of Plug Power right now, you aren't just betting on whether the hydrogen tech works.
No.
You are betting on whether they can survive without severely diluting your ownership.
Precisely. And let's break down the actual mechanics of that dilution, because the current stock price makes it uniquely punishing.
Right, at $2.
Yeah. So if a company's stock is trading at, say, $20 a share, and they need to raise $60 million, they only need to issue 3 million new shares.
Which is, you know, a drop in the bucket usually.
Right, it's manageable. But Plug Power is trading at $2.17. To raise that exact same 60 million, they have to issue nearly 28 million new shares.
Ouch.
Yeah. And the lower the stock price drops, the more shares they have to print to raise the same amount of capital, which heavily dilutes current investors, which then drives the stock price even lower. It's a vicious downward spiral known as a death spiral.
And frankly, looking at the insider behavior right now doesn't exactly inspire confidence that they have enough gas in the tank to avoid that.
No, it doesn't.
Because there is zero evidence of insider buying right now. The report actually flags an open market sale of 50,000 shares by an insider.
Yeah.
Now, 50,000 shares isn't like a massive corporate dump, but if the executives sitting inside the car genuinely believed they would coast into the gas station safely, you would fully expect them to be buying equity at $2, not selling it.
Absolutely. Insider selling is always heavily scrutinized during a liquidity crunch like this.
Yeah.
Executives will often claim they sell for tax purposes or portfolio diversification, but the market interprets it as a complete lack of conviction.
Naturally.
It deeply reinforces that show-me attitude of institutional investors. They are just sitting on their hands, waiting to see if management can actually stretch that 162 million.
But that begs the question of how they actually stretch it. And the analysts highlight management's internal initiative, which they're calling Project Quantum Leap.
Sounds very sci-fi.
It does. But the goal is just structural cost reduction. We saw the gross margin improvement, obviously. But the most aggressive move is happening in their capital expenditure.
Right.
They slashed CapEx from $79 million in the first half of 2025 down to just $8.7 million in the first half of 2026.
That's incredible.
It's an 89% reduction in 1 year. How does an industrial manufacturer just stop spending money on capital projects without entirely halting their business?
Well, you essentially pull the emergency brake on the future.
Okay.
Capital expenditure is the money spent on buying, maintaining, or improving fixed assets, factories, heavy machinery, vehicle fleets, that sort of thing. Slashing it by 89% means they aren't expanding capacity at all.
Right.
They're likely deferring non-essential maintenance on existing equipment. They're basically squeezing every single drop of productivity out of the assets they already own.
It's pure survival mode.
Yeah.
But there's a massive hidden cost there, isn't there? Because Plug Power is theoretically a growth company in the rapidly evolving green energy sector. You are competing globally. If you starve your research, development, and infrastructure for an entire year just to make it to Q4, I mean, you are essentially eating your seed corn.
Yeah, you are.
You survive the winter, but what do you plant in the spring?
That is the exact trade-off.
Yeah.
They are optimizing for short-term liquidity over long-term market dominance.
Yeah.
It highlights just how dire the cash constraint actually is.
Right.
But to be fair, they aren't entirely abandoning growth. They are just trying to be highly, highly selective.
Right.
The report highlights a couple of key strategic levers they are pulling, primarily a 50-megawatt electrolyzer project in Australia.
Let's ground that technically for a second, just so we're all on the same page. An electrolyzer is the technology that uses electricity to split water into hydrogen and oxygen. So they are building a massive facility to generate green hydrogen. But why Australia?
Well, Australia is aggressively positioning itself as a global hub for green hydrogen because they have vast, unpopulated areas that are just perfect for massive solar and wind farms.
Oh, that makes sense.
Yeah, if you can generate incredibly cheap renewable electricity, you can run these electrolyzers profitably to create green hydrogen for export. For Plug Power, this project represents a really vital diversification away from their historical core business, which was, outfitting warehouse forklifts with fuel cells and moving into utility-scale global energy infrastructure.
Diversifying is great, obviously, but there is another potential revenue stream in this report that really jumps off the page.
The Microsoft deal.
Yes. The report details a backup power collaboration with Microsoft. Now, with the massive energy demands of artificial intelligence right now, we know data centers are absolutely desperate for power.
Yeah.
So a Microsoft partnership sounds like an absolute goldmine. But here's where it gets really interesting to me. The Plug Power CEO went out of his way to publicly caution that this test does not represent a, quote, strategic pivot yet. Why on earth would the CEO downplay a partnership with one of the most valuable companies on the planet right in the middle of an AI boom?
It seems totally counterintuitive to downplay good news, right?
Yeah.
Especially when your stock is sitting at $2. But the mechanics of Wall Street modeling actually explain the CEO's restraint here.
How so?
Well, a data center backup power play using hydrogen fuel cells is a phenomenal narrative. Data centers can't rely solely on the traditional grid anymore, and traditional diesel backup generators are facing massive environmental pushback.
Right. Nobody wants more diesel burning.
Exactly. Fuel cells are the clean alternative,
Mm-hmm.
but tech pilot programs are notoriously slow and fraught with integration failures.
Oh, so he's actively managing expectations.
Exactly.
If he hypes up Microsoft as this massive strategic pivot, the market will instantly bake that future revenue into the stock price today.
Precisely. Analysts will start modeling hundreds of millions in speculative data center revenue. And if that pilot takes 3 years to scale instead of 3 months, which, let's be honest, is highly likely when you're dealing with novel utility-scale power integration, the market will punish the stock mercilessly for missing expectations.
That makes total sense.
Furthermore, Plug Power has spent years losing credibility with investors over missed targets in their core material handling business. You don't rebuild that trust by abandoning the core business narrative for a shiny new AI pivot the very second you finally hit break-even margins.
Right. You have to prove you can execute the boring stuff first.
Exactly.
They have to prove they can walk before they try to sprint alongside Microsoft.
Yeah.
So we have this incredibly fragile ecosystem right now. We have operational momentum in Q2, but severe liquidity threats, extreme capex cutting, and a few high upside growth levers. The analysts outline exactly how the next 6 to 12 months could play out, and they break it down into a blue sky scenario and a thesis breaker.
Yeah. Let's start with the optimistic path. The blue sky scenario assumes the Q2 break-even gross margin wasn't just some accounting fluke or a lucky quarter of raw material pricing.
Right.
It assumes the margin holds steady or even expands into positive territory in Q3. If that happens, they bridge the gap to Q4, hit positive EBITDAs, and fundamentally change their cash burn profile.
And crucially, that means they avoid that catastrophic equity dilution we talked about earlier.
Yeah.
They don't have to call the tow truck.
Right. And if they achieve that, while the Australia project and the Microsoft collaboration continue to progress, the analysts suggest a massive potential re-rating of the stock.
Okay, let's talk numbers on that.
Well, the report notes Plug Power is currently trading at a price-to-sales multiple of 4.33.
Yeah.
Now, a 4.33 multiple is fascinating context. For a traditional low-margin hardware company, a 4x revenue multiple is outrageously high.
Yeah.
It implies the market still expects significant future growth. But for a rapidly scaling green tech leader, it could actually be considered cheap. If they prove the turnaround is real, the analyst average price target sits around $3.50.
Which is roughly a 60% jump from the current $2.17.
Yeah.
But, I mean, that blue sky scenario requires literally everything to align perfectly. Margins have to hold, the 16% growth target has to hit, Project Quantum Leap has to squeeze out costs without, breaking the machinery, and there can be zero unexpected cash strains.
It's a lot.
It feels less like a financial forecast and more like threading a needle in the dark.
Which perfectly explains why the analyst consensus rating in this report is a 5 out of 10.
A strict neutral or hold.
Exactly. Nobody is willing to pound the table and tell their clients to buy this yet. The market is waiting for the thesis breaker, which is the Q3 earnings report.
The linchpin of the entire narrative.
Yeah. The Q4 target is the destination, but Q3 is the final checkpoint. The entire bullish thesis unravels if Q3 gross margins slip back into the negative.
Because if they regress, it completely invalidates the narrative that Q2 is a structural, permanent turnaround.
Yes. The market will instantly assume Q2 was heavily influenced by a one-time pricing mix or some favorable inventory accounting.
And if the margins regress, the cash burn accelerates, that $162 million buffer evaporates way faster than expected, and they are forced to announce an equity raise at $2 a share.
And if that toxic dilution scenario hits, the report warns the stock could plummet back toward its 52-week low of $1.41. It is a binary show-me moment for management.
So what does this all mean for the listener? I mean, if you are holding a broad green energy ETF, you likely have exposure to this exact drama.
Very likely, yeah.
Plug power is just the ultimate test of investor patience in a sector that is notorious for burning cash to chase innovation. They have finally proven that it is mechanically possible to stop the operational bleeding. But they are trapped in a brutal race against time to prove it wasn't a fluke before the bank account hits zero.
It's a classic battle between underlying technological value and harsh balance sheet realities. The revenue growth and the addressable markets, those are real, but the historical cost of operating has left them with absolutely zero margin for error today.
Yeah, perfectly said. And I want to leave you with one final thought that builds on something we discussed earlier, which is that Microsoft backup power test. We tend to think of hydrogen fuel cells as an eco-friendly alternative or just a, nice to have green initiative for tech companies looking to boost their ESG scores.
Right.
But look at the broader mechanics of the global energy grid right now. AI data centers are devouring electricity at completely unprecedented rates. We are already seeing localized grid max-outs and power constraints in major tech hubs.
Mm-hmm.
What if, in just a few years, hydrogen fuel cells aren't just an alternative? What if the traditional grid simply cannot physically carry the load, and these off-grid hydrogen solutions become the only viable engineering fix to keep the AI revolution from literally blowing a fuse?
That's a fascinating way to look at it.
It really makes you look at the underlying technology of a highly volatile $2 stock very differently.